Now, as we continue the conversation on the housing front from how we ended the previous segment, you can see the home buyer traffic for home builders. So the home buyer traffic just collapsed to the lowest level since the start of 2008's housing crash, which is down 61% year on year. And the key piece to where we were in the lockdowns, and I think a lot of people kind of appreciated that the lockdowns was going to be temporary in the sense of lockdown, but there was a 2-month period where you really couldn't do much, but then virtual tours came in. If you wore clean smocks, face mask, everything, you could go and look at homes again. But now we're coming to a similar point in the 2008 housing crash, and look at how that really remained over the next, let's call it 5 years. And I think we're going to see something similar. Again, we were very early in that call. It's just based on the leading indicators that we're seeing, the pain on the interest rates, which even at that point were nowhere near where we are today, plus just a lot of the froth that has been built into the market with massive easing since 2008 is, again, I have a decent amount of confidence, again, famous last words, that we will continue to see the pressure at this point in time. So then when you look at the September housing starts, which were down 8.1% versus the estimate of being down 7.2%, in the building permits were up 1.4% versus the estimate of negative 0.8. So again, you're seeing this movement in terms of the new privately owned housing unit starts coming down, private housing authorized by building permits, flatlining. Because people are still going to try to get their permits, especially there. I know, at least personally, some people that held off on getting permits and everything else until the market got a little bit cleaner. Now, one of the on the positive side, which is something that I forgot to get the chart for, is that there's a view that you're going to get a little bit of a bridge when you look at remodeling, where people are coming in and you'll see remodeling continue to be fairly strong. I would say that is likely, but I think it's still early to say that will carry us, just because a lot of people are going to be in a lot of pain. And I don't see anyone really going out and redoing their kitchen when there's uncertainty of what their 401k looks like, what their finances look like, which again will keep us and the activity fairly reduced. Then when you look at refinancing, has fallen to the lowest since August 2000, because why would you ever refinance at these rates? Unless you have an arm and you're scared and you're just going to lock in, it's going to be very difficult to see that continue. And then when you look at home builder sentiment about future sales, is at the worst level since 2012, rivaling the plunge seen during the great financial crisis. So again, on the future sales, you're seeing something very similar when you're looking at new buyer traffic. So the sales, the traffic are all trending in the wrong direction, with rates all heading in the wrong direction, giving us that confidence that we're going to see a lot of this pressure. Single family current sales for October were down to 45. Expected sales, as you can see, continuing to move lower. All of this is just showing and confirming what we've been calling for since the summer, where we really started to see this roll over in an aggressive fashion. And then the home builder confidence and housing starts. So housing starts still remain elevated even against home builder confidence. And I think clearly you'll see housing starts roll over. But everyone talks about the disconnect between starts and family formation. So there is some credence to say that starts will remain elevated and have, but now you have the most homes under construction in history. So when you look at those completing, there's going to be a new wave of product coming to market, which is going to push and put even more pressure on the underlying market in terms of on the housing front. Now, when you turn that again further to the consumer, retail sales are up a decent amount when comparing to pre-pandemic peak, which was the blue, but measuring strength against CPI, which is that yellow line, looks much weaker, and the gap continues to widen and this comes down to the volume versus value, where the value of things is going up, but the volume is starting to roll over. And that's when you look at people, because I've had these discussions with individuals where they've gone to malls and they're like, why is the mall packed? And it's like, well, people still want to get out. They're tired of being in their homes. But you have to look at how much stuff are they walking out with. Is it one bag and it used to be three? Are people just browsing and not actually buying? Or are there sales that are driving that, all of which would really bring down that underlying value where you see some of this rollover, see some of this compression? And I think when you look at the retail sales on the backdrop of a strengthening CPI, you're going to see even more pressure. So then when you look at the average hourly earnings, they move negative again. You know, when you go back to 2008, this is the lowest real wages have been in going back to 2008. So again, you see this pressure point, and this is going to be where the rubber meets the road in terms of the pressure on the consumer as real wages sink, as savings fall, and they've tapped out their credit card. When you look at the bank deposits, down another $117 billion last week and $325 billion in the last 6 weeks. The only week in the last 40 years greater than last week was the week after 9/11. And this is coming as M2, the money supply, is falling quickly, but also people are taking money out. And that's why when everyone points to all of the money sitting in savings and this can bridge the gap, it can come out very quickly because you don't know what people are sitting on in terms of debt and where their comfort level is on the credit card side, because we've seen credit card debt go to a recent record. So they're going to have to try to pay that off. They're going to have to try to bring that back under control. And you're seeing a lot of these pressure points, which we think is going to continue to mount, especially when you look at where inflation is. September CPI was hotter at 8.2% versus the estimate of 8.1%. Core came in at 6.6% versus 6.5%, and it was prior 6.3%. So again, you saw a reacceleration on the core side of 0.3%. And if you look at Cleveland median CPI, Cleveland's trim mean CPI, they're still above core. So you still have an inherent driver with the leading indicators and other indicators showing you that core CPI is not done going up. Then when you take it to the convergence of core goods and commodity core services and core goods, we've been saying there's going to be a meet in the middle, and here we are. We're crossing over. But remember, core services are stickier than the commodity side and their other piece. So it's important to look at core services is up 6.7%, and that's going to attribute more to sticky inflation than the commodity side. Hard to see on the chart, but food component of September CPI inflation improved slightly, up by 11.2% year on year versus the prior 11.4%, still near the fastest rate going back near to the 1980s. So again, food is still going to be that overhang that we've continued to talk about. When you look at less food, we're zooming in specifically on core CPI, which is now up 6.6% and rising at the fastest rate since August of 1982. Owner's equivalent rent portion of September CPI continued to surge, up by 6.7% year on year, and now climbing at the fastest pace on record. So when you look at just where we sit, this is the acceleration. You have some things are starting to find a floor, but when you look at owner's equivalent, as we've been talking about since last year, this was going to be a reacceleration point, which is why when you look at flexible versus sticky, we've been saying that sticky inflation is going to have a upward trajectory, and you're going to see that continue because you have a lot of this backlog that has to still move through the system. Sticky inflation is going to reaccelerate to the upside when you look at electricity, when you look at heating, when you look at gasoline, diesel. So there's going to be some elevation, but even after sticky inflation has come down as much as it has, which it's still at the highest points it's been since the 1970s. So even after it's gone from 20 to 13, you're still at 1970 era levels with sticky inflation way more upside, because when you look, especially in the early 70s, The flexible accelerated, and even after you had flexible starting to come down, you didn't have sticky start to roll over. And this is something that the Fed is looking at, especially when they started cutting rates too soon in the 70s, re-accelerating the inflation side and causing that second turn up, which then created that wage spiral. So when you look at the staple items for consumers, utility costs, gasoline, food at home, electricity, getting expensive, but at a less aggressive pace. So they're now at 19.9% in September versus 22%. So it's still rapid and at one of the highest levels since the 70s. And this is, again, hitting people hard, which is why when we look at housing and retail sales, this is now, you've had multiple months over a quarter and a half now, and it's now starting to eat into people and how they spend, and that's where we see more of this pressure coming through, which is when you look at retail sales came in at flat versus the estimate of a positive 0.2, and when you look at the control group, slightly better, but this is again that plateau, that rolling over where you flatline and then you start to turn, which is when you look at retail sales and then retail sales adjusted for inflation, you're still below the peak and you're starting to see that move down. Now, you can see here on the retail sales side on the left, when you use the deflator, it started to pick back up, which is a positive where people were still spending as they came into September. But then you look at the control group and that's where the flatlining is there. And we see this as the pivot point where the next move is down. The U.S. real average weekly earnings is a big driver of that. You're at the lowest level since the 2000s, and then Americans suffer pay cut as inflation outpaces wage growth. So consumer price index at 8.2%, average hourly earnings at 5%, and just give you that disconnect between the two. And when you look at wages and CapEx, they're actually coming down. So when you go to this slide here, you see that the Atlanta Fed wage growth tracker actually ticked down this past month as inflation ticked higher. So obviously household spending growth expectations is rolling over. Slight move down in the spread, but it's still elevated relative to history between job switchers and job stayers, wage growth per Atlanta Fed. So people are getting more and more concerned when you're seeing that rollover, and it's because people are like, look, I don't want to risk it. The market's getting a little tough, and that's where you're seeing a lot of this slowdown. Small business compensation plans is for 6 months in advance is coming down, and then when you look at the CEO confidence coming down as well. So when you look at this, again, wages are in a negative trajectory on a leading indicator as inflation is at a positive, if not stagnating piece, which is going to eat into the capacity for people to spend, which again, you saw here with the wage growth as tracked by Atlanta. Latest update shows 6.3% growth in September, which is the first sign of easing since October 2021. So again, wages are coming down and coming down at the worst time when you consider going into Christmas, and these fears are going to compound to create that pivot. October Empire Manufacturing fell, as we're seeing when you factor all of these in, again, kind of coming back to and connecting it to what we already talked about, you see more of this additional pressure to the downside, which is then married with the consumer sentiment, the current conditions. When you look at where things are headed, and then putting it all together to look at the consumer expectations moving lower. And then you look at economic sentiment index, again, rolling down with the new jobs rolling over, U.S. economy coming under pressure, major purchases slowing, and again, that new home piece continuing to diminish. All the while, U.S. import price index came down a bit, while the portion of PCE components experiencing inflation exceeding 3 to 5% is at the highest it's been since the 80s. And again, it's the pace in which and the breadth at which things are moving is going to keep this upward trajectory intact, which is why we are so concerned and remain concerned about inflation, and with good reason. And I think the Fed is as well, when you look at what their expectation is of them, again, raising rates again, as we talked about in segment 2. So that's what we have for you in the U.S. The next segment is going to go deeper into Europe and some of the things that we're looking at as we prepare for the ECB.